Welcome to Subramani. I've said a lot of nice things about equity markets. So now let me tell you some harsh things about equity markets. The most important thing is most people who come into equity markets often lose money. I have even said that markets always keep going up, but people always lose money. Now let us look at the reasons why people lose money in the markets, and almost always. First of all, we have a very small portion of our population investing in equity markets at all, which would perhaps be less than 3%. Even if you take directly, indirectly. Of course, if you take life insurance into account, that number may go up a little bit, but that's about all. About maybe 5% is what it will be, including the investments in insurance and through which money comes into the equity markets. Having said that, there are very simple reasons why people lose money in equity markets, and all of that is controllable. First of all, people do not make a difference between trading and investing. Most people keep saying that investing has become more easy. It is not true at all. Investing has become far more difficult today in 2020 than it was for us in the 1980s and 90s, and I'm not joking, right? Yes, you have to go to a broker, you have to call him up, you have to give him your order, and end of the day he will tell you at what price he bought. You were not very sure whether the price was true, you were not sure how much of brokerage you could negotiate. All those things were tough. The execution portion was tough, but the execution portion has been simplified. It does not mean investing has been simplified. We were not inundated with so much of nonsense about why we should be worried about Biden winning or Trump winning. We were not bombarded so much, and we were not confused so much, so we could remain calm more easily. Having said that, if you do not know the difference between trading and investing, you are in trouble. Most people buy a share hoping to sell it off next day at a higher price. But if they can't do it, maybe next week, maybe next 10 days, but if the price goes up, they just hold it on for eternity, right? So somebody has bought a share for 70 rupees, it falls down to 30, he will not sell it or she will not sell it till it comes back to 70, even though in the meanwhile many other shares which are at 70 have become 140. So the opportunity loss is never understood. So they will not sell at a loss. So they hope to sell at a profit. They don't sell, and therefore they hold on maybe for 3-5 years, and then one day in frustration they sell it off at 20 rupees. Or the minute it touches 70 rupees, they sell it and say, I didn't lose money. That is the difference between trading and investing. You have to be very clear that you have a trading portfolio separate from an investing portfolio. If you can't do that, be just an investor. Don't be a trader. It is far more difficult to be a trader than to be an investor. And very importantly, the investors look down upon traders. So your ego also might be hurt saying you're only a trader and not an investor. It doesn't matter. Stick to trading only if you are good at it. Don't do trading if you do not understand how to trade. It's easier to be an investor. I'm just repeating what I said. Second, it is easy to say don't panic when the markets are down. I did not panic in March 2020 because I thought it was a great opportunity to buy, and I bought. I also know ICICI Prudential, AMC bought a lot of stocks in the March decline, March 2020 decline. But please understand, this is all so many years of experience coming into play. You will panic. If you were a 25-year-old and you had put 50,000 rupees and that had become 20,000 rupees, you will panic. Or it had become 30,000 rupees, you will panic, because people around you will make you panic. Your dad will tell you something. If there's no prior equity experience in the family, they'll tell you, see what has happened, sab doob gaya, PPF mein dalo, that kind of a thing. So you will be bombarded with absolutely wrong, stupid, scared knowledge to say. So you will panic. What happens is when you're young, you panic, you lose less. You don't lose too much, right? Because you're young, you don't have too much to lose. However, by the time you're 50, you would have seen enough falls and rises which have happened, and therefore you would become a better investor. Third, we largely believe that we can pick stocks. We know that if you keep buying ITC from 300 to 100, you will make money. This is kind of nonsense gets given to you on Twitter and other social media. This is not true. Stock picking is not so simple, right? Of course, there is a dividend yield which you should consider, but what is the use of dividend yield if at the end of the day the price falls by a bigger amount? Look at people who have invested in ITC in the last 2 years. They would have bought the share maybe even at 200 thinking there's a good dividend yield. Yes, there was a dividend yield because there was a dividend, but having said that, the loss in the value of the share is far greater than the dividend, so it doesn't make sense. So don't go by stupid theories available on social media, videos that are available on social media which tell you they will teach you stock picking. They can't. If they knew stock picking, they wouldn't be making videos, right? They would be picking stocks. So stock picking is not easy. Some of us have done it over long periods of time. We have got extremely lucky. I mean, a big portion of my portfolio is built up in 1977 when George Fernandez threw out the multinational companies out of India, and therefore they had to do an IPO, and therefore the Nestle, Colgate, Siemens, Cummins and all came out with an IPO, HUL. And therefore people like my father picked up those shares, and therefore we made money. It is luck. It is sheer luck and timing. You can't say why did my father not pick up in 1977? Good question. Why did my father pick up? Sheer luck. I don't think. And I would think it is my skill that we did not sell it. That is skill. But yeah, it is luck to start with, right? Then so you will panic, and you will can't stop you from panicking. Then the worst part of panicking is you will sell, book your losses, and then when the market does a V-shaped recovery and crosses the previous high, say a Black Monday or any of those days, after that you will again come back to the party and looking for your seat, and your seat won't be available, and it will be available at a huge premium, right? So therefore entry exit timing is something which is very, very, very tempting, and therefore we will all do it. We will continue to do it. Even with experience we will do it, and that would be stupidity, but we will do it. We also lose money because we think we can pick funds. Picking fund schemes is impossible. CEOs of mutual funds go wrong, and wrong terribly. So don't think that CEOs, CIOs get it right. They don't get it right always. Overall, if you have got more right than wrong, that is good. And if you have put more money when you're right, you would have made more money. Making money is important, not being right. Because when you could be right and not have invested, or you could be wrong and be fully invested. So don't get into that thing that if you should always be right. Overall, if you make money, you have more rights than wrongs, that's good. And you put more money during times when you were right, that is even better. Right, so these are all the causes, reasons why people lose money in equity markets. If you don't want to learn equity markets, there is a simple product called an index fund. I'm not saying that there will be no other funds which will beat the index fund, but you do not want to learn the process of stock picking, etc. And there's no one single book which is available which teaches you stock picking and makes you an expert. Yeah, you have to read a lot of experts, see what they have done. It's a little painful process of learning. If you don't want to learn, stick to an index fund. Keep putting as much money as you can in an index fund. Keep some money for emergencies. Keep it in a liquid fund or a ultra short bond fund, and all the other money you keep on putting into an index fund. Putting money in an index fund in the long run is the best thing to do. Whenever you have a surplus, keep on putting it. Treat your index fund like a savings bank account. Whenever you have a surplus, keep on putting money into it. Don't worry too much, especially money which you don't require for 2 years, 3 years, 5 years, 10 years. Just keep putting money into it. And for all other expenses and other emergencies, have an emergency fund. Life will work like this because you always have your PF, PPF, NPS for your debt requirements, all other money in an index fund and one ultra short bond fund to meet emergencies. This is such a simple theory and will work. You will not be the darling in all parties talking about your latest, how you sold Infosys and bought Wipro, or sold Mindtree and bought HappyMind. Happiness, you bought Happiness Technologies or Happiness whatever. and you will not be able to do all those conversations, but most importantly you will be able to make money, and end of the day that is